Hi, this is Sean Johnson from Centric Wealth Advisory. This is another video of a template that I'd like to show you. It's a very basic one in terms of the calculations, but it's more for information purposes relating to the two-pot system. Now, I'm aware that there's a lot of information online from various institutions and various sources of journalists and also the other financial planners sharing information on the two-pot. This is really just my contribution towards the topic. I'd like to just go through the information from the National Treasury, explaining what the two-pot system is, why they are implementing the two-pot system, and then I'm going to then swap over to my Excel template, which you can download and use for your own personal benefit. It is for educational purposes. I'm using a very basic calculation on that. I'll also provide a link to a very useful calculator, which Innate has kindly created on their website. And that shows you the implications of accessing your savings from the savings pot and how that will impact your retirement planning in the future. I will provide a link to that if there is time on the video and we're not going over a 20-minute mark. I will do a share screen onto that calculator and just show you. I don't want to make this video too long, but it is important to explain the different components because there are three of them, even though it's called the two-part system. The two-part relates to all contributions after the 1st of September, but up until the 1st of September, there's essentially an additional component called the vested, which I'll explain to you. But first, let me just do a share screen from a PDF document. So this document was created by the Treasury of South Africa. It was issued in 2024. I'll provide the link for you to download this. It's 4 pages long, and you can just go through this in your own time. They do provide an example over here, but I do have a calculator which does exactly the same thing for own benefit to put in your own values just to show how it works. So let me just first go through what exactly is the two-pot system. So the two-pot system, I just want to quickly zoom in so it's easier for you to read. The two-pot system is a reform that will allow retirement fund members to make partial withdrawals from the retirement funds before retirement while preserving a portion that can only be accessed at retirement to help improve outcomes. This means members do not resign to access part of their savings benefit if they are in financial distress. This reform will come into effect on the 1st of September. So as a certified financial planner, my view on that statement is, well, firstly, I don't know what percentage of people are resigning from their employers to access the retirement funds. I do not have that information. And secondly, if you have a financial planner and you contribute towards retirement funds, in this case, it's a pension or provident fund because you have to resign from your employer to access these funds. You can't do that with a retirement annuity. You have to have savings in place already. You need to have emergency funds. You need to have some form of savings that is liquid that you can access in an emergency so that you do not have to resign from your employer. Again, I don't know what the stats are of the number of people resigning from their employers to access their funds. But I will just say that if you access your funds from a pension provident fund once you've resigned, you are taxed quite heavily on that because they apply what they call the withdrawal tax tables. And that's on a sliding scale. And depending on the amount that you're taking from your pension or provident funds upon resignation, that could be quite sizable. So it's not really ideal. Who is it meant for? The new system will apply to all retirement funds, that is both private and public sector, except for old generation or legacy retirement annuity policies or funds with no active participating members, such as funds in liquidation, beneficiary funds, closed funds or dormant funds, pensioners and members of provident funds that were 55 and older from the 1st of March 2021 who have not opted to be part of the two-part system will be excluded. I've made a point of that on my spreadsheet as well. And then why the two-part system? This sort of gives you a bit of insight already, but let's read what they say. This system is meant to support long-term retirement savings while offering flexibility to help members in financial distress. In many cases, retirement funds are the only savings, to put an alarm bell already, that fund members have. Under the new current system, some members resigned to access the retirement funds to pay off debt. Yeah, as I said, you get taxed on your withdrawals, so not really the best strategy there. Which is detrimental to economic, financial planning, and retirement provision point of view. The two-part system is meant to help fund members in times of financial difficulty. Debatable. By allowing access to the savings component before retirement. Okay, well, if you take money from your savings, you are taxed at your marginal tax rate. So, yeah. It's advisable that members use the savings component sparingly and only when there's a dire need. And this is where the issue arises. You are giving the public the ability to access their savings pot, which I'll explain on my template. But if they keep doing that, who is going to show them the implications of their retirement plans? That's why I said earlier, Innate has done an exceptional job of creating a calculator, but the name and land in the streets is not going to find their calculator and is not going to understand the implications of accessing their savings pot on an annual basis, which doesn't make sense to me. So that's why I wanted to make my own contribution towards the two-part system, so that you have more information on hand to understand what it means practically and also how to use an example, but also to consult a financial planner so that your savings is in place. You don't have to access your retirement funds because it's a psychological thing. If you continue to eat into your savings pot every year, 1/3 of your retirement is eroding. You're only going to rely on the retirement pot, and it's worse because there's a vested component which I mentioned, and all the fund rules on that vested component are still in place. So if you resign from an employer, that vested portion still has the rules where it says you can resign and withdraw the full amount, which I'll show you a bit later on. So I don't think it's the greatest system, firstly. I think they should have gotten a lot of actuaries and smart risk analysts to put together a more robust system, because every year the treasurer is going to have to release how much money is being accessed from savings pots. It's simple as that. Yeah, that's just my view. I'm just looking at the long-term implications of billions being taken out of savings pots and the tax implications thereof, because SARS receives that as income and tax, because they're taxing they're taxing the amount that you take out that's added to your gross earnings. So it pushes you into a higher tax bracket, which I'm also going to show you on my template. But anyway, let me do a share on my spreadsheet quickly. I just want to pause this and then open up mine. Right, so this is a Centric document I've created for educational purposes. Our stance is very simple. The two-part system does not exist. We will not encourage investors to touch their savings pot or any money up until the 31st of August. As a certified financial planner, I can see the long-term issues of this. And unfortunately, we have a government that implements things without really doing the due diligence. And then years later, when they realize it was not a success, the damage has been done. As I said before, I don't know what the percentage of people resigning from funds are and what they're accessing, but we will be able to see going forward from the 1st September who has accessed their savings pots and what was the tax that's been gathered by SARS in doing so. That has to be available to the public to see if the system is actually working compared to what it was prior to the 1st of September and people resigning and accessing the full amount using the withdrawal tax tables. So I'm kind of skeptical about this just because I'm running the numbers in my head and how this works mechanically. But nevertheless, I'm just going to go through the implications before and after, and then I'm going to do an example here to show you the implications practically of the 1/3, 2/3 going into the two pots. So as I mentioned in the beginning, there's 3 components. The reason why I've called this component in 2 pots because it's called the two-pot system, even though there's 2 components. So up until the 31st of August, I'm just going to read what I've gathered. Now, just full credit, I got this information from Stanlib and 91. I am a huge fan of Stanlib. They do have really good content on their sites. Brilliant. And 91 had a really, really nice document which they released on an email, which I got a bit more information. So I sort of combined the two together. There's a lot of information, as I said, online, but I've got the key information that has been put into the summary here, which I've bolded for you just to read through. But I've also taken this from the various sources and put it together. So I just want to read through this with you. You obviously can go through this in your own time to better understand it. It is online as well. There's so many videos relating to this topic, but I just wanted it to be in one spreadsheet, and then you can then play around with the calculations over here. So up until the 31st of August, these are all the savings that accumulate in a retirement fund up until that date. These retirement savings will continue to be regulated in terms of the rules that apply up until the 1st of September. Where applicable, your vested and non-vested rights or portions as of the 31st of August will form part of the vested component. Retirement funds. For retirement annuities, generally, you cannot touch these savings until your age 55 minimum. For pension and provident funds, the vested component will remain exact for compulsory preservation, so you can withdraw a taxable lump sum should you resign or be retrenched. For preservation funds, current rules still apply, and all existing vested rights will be retained. So what that means is if you belong to a pension or provident fund or a pension preserver or provident preserver, all the rules up until that fund value, so let's say the fund value was 400,000 Rand, that 400,000 Rand, of the 400,000 Rand, because it's going to be an explanation taking a portion out, 370 will be applied to these rules. So let's say, for example, you belonged to a pension fund, 370 sitting in your vested pot, or component, sorry, and you then resign from your employer. You still have the right to withdraw the full amount, and you'll be taxed accordingly to the legislation, which currently states a withdrawal tax table calculation will be done on that money, or you can put that money into preservation, etc. So you're still allowed to do that. If you have a preservation already, you're still allowed to apply the discretion of the partial or full withdrawal before your dates of retirement. So all the rules stay the same, but it's allocated to a certain amount, which is up until the 31st of August, which in this case we said was 370. I'll explain why there was 30,000 taken off now, get there. But I just want you to understand that all the rules applied up until the 31st of August will be applicable to that set amount that is vested. And they should give you statements from your employer showing you what is the vested component, what is the savings pot, retirement pot from that date, so that you know. Obviously, the vested component will still grow with interest, but it's just important to know because it's when you start resigning and being retrenched, the taxes will be different because of the access to the savings pot, which I will get to. So from the 1st of September, legislation allows you to access your money. However, there is a minimum limit on the amount and number of times you can withdraw. The amount is 1 a year. The exact dates which you can make your first withdrawal is dependent on the retirement fund you are a member of. Your vested component will provide initial capital for your savings component. So you are limited to 10% of your fund balance, capped at 30,000, and that's applied to the amount up until the 31st of August. So in this case, let's say you've got a fund balance of 400,000. 10% of 400,000 is 40, so you're capped at 30. 30,000 is the amount that's going to be allocated to your pot. We call that seed capital. To withdraw money from your savings pot, you need a minimum of 2,000 Rand in your pot to do so. If it's below 2,000, you cannot access it until you do have, obviously, 2,000 or more. With the retirement funds, every withdrawal you make from your savings components pot is added to your taxable income or be taxed at a fixed marginal rate. Now, what that means is any amount you take from your savings will be added to your gross income, your taxable income, and that will then be applied using this tax table. This is the current tax table for the 2005 tax year. It has been unchanged from last year. Every year, obviously, there'll be changes if SARS does decide to change the boundaries or whatever. The highest tax rate currently is 45%, and that's for earnings that are 1.8 million and above. At retirement, the member will take 1/3 from the invested component as a lump sum, which is the amount up until the 31st of August, and that will continue to grow, as I've mentioned. You still allowed the 1/3. Subject to tax, and that will be using the retirement tax tables. And the 2/3 must be put into annuity. The retirement pot must be used towards your retirement. And of course, with the savings pot, that becomes the 1/3, which you can then use as a lump sum, and that'll be taxed using the retirement tax tables, because now you're retiring from the fund. Right. So let's go and do an example now. So the vested components, we say the 400,000 Rand is the amount up until the 31st of August. From the 1st of September, what do? They're going to take 30,000 Rand from that amount, and the balance of 370 will be vested. So that will have all the old rules apply to that portion. Then you've got your savings pot, which is the 1/3 contributions going forward, plus the 30,000 Rand in this case, because it's above sorry, it's 10% or 30,000. So 30,000 is the cap. So that 10,000, sorry, the 30,000 will be carried into the savings pot, and then anything you make into the retirement savings will be split between 1/3 and 2/3. Thereafter, 1/3 of all new contributions will be allocated towards the savings pot, and this will also grow with interest investment returns. So at retirement, either the full or partial withdrawal can be made, and the retirement tax tables will be applied. So before retirement, if you access money from your savings, you're taxed at your marginal rate. After retirement, you can take a partial or full, and that'll be taxed using the retirement tax tables. With your invested component, if you get to retirement, you can take 1/3 as a lump sum, 2/3 as a compulsory annuity. The tax tables applied on the lump sum will also be the retirement tax tables. And of course, when you get to resignation and retrenchment, I'll get to that now. These slightly different variations for the invested portion and the savings portion. Because the savings portion you can access before you retire. If you still belong to your pension or provident fund here, you have to resign. Not that I recommend you do, or you can put that into preservation, etc. If you do resign or change jobs, as I said before, there's three decisions you can make regarding the funds that belong to a pension or provident fund. You've got the retirement pot. 2/3 of your contributions will go towards your retirement component to remain untouched. All future growth and earnings remain as components and must be used to purchase a living annuity or guaranteed annuity at retirement. There are some exemptions, such as the fund balance below 275. And if you've been a non-tax resident for a period of 3 years, you basically immigrate, then you can access your funds through the South African Reserve Bank. You can open up a block account, etc., and you'll be taxed. Why? Because all interest and capital gains in your retirement funds are tax exempt. You don't pay tax on that. When you if you withdraw from a fund here, you are taxed at your withdrawal tax table. When you retire from a fund, you're taxed using the retirement tax table on here and on here for the amount here and 1/3 here. If you resign from your employer, you can no longer make partial or full withdrawals. So in other words, you cannot put this money into preservation. Why? Because this was accessible prior to resigning, and this you cannot touch at all, unless obviously I mentioned below 275, or if you essentially leave the country, no longer become a tax resident for preceding 3 years. So that's also important to note. But again, I just said Centric's view is we're not even worrying about this whole thing because it's just a mess, in my opinion. I would really look at doing the tax rebates from your investments, putting that into a emergency fund or an investment that can be accessed at any time. Yes, it will be taxed on your interest that you earn from that, but it's money that you can use. It's completely separate from your retirement component, and it's a tax rebate. So it's money that you've contributed towards a retirement fund already. You get it back as a rebate and you put it into a savings. Yes, you're going to get interest. You do have interest exemptions per year. But the point I'm making is you don't want to see the savings component as any liquidity when it comes to retirement planning. And I've got a separate template I'm going to go through where you can reinvest your rebates back into the fund. And I've got another template which is a really comprehensive template, which is for retirement planning, which we'll get to. That's going to be quite a large video. I might break it down into a series of videos because it's massive calculator I've created to work out all your retirement needs and what provisions you need to have and how to meet shortfalls when doing your retirement planning. We'll get to that. So in summary, with the fund balance of 400,000 Rand before the 1st of September, 10% or 330,000 of the fund balance will be allocated towards your savings component, and the amount of 370 will be invested, and existing legislation will continue to be applied. Members of preservation funds before 1 September who have not accessed their once-off withdrawals will be still permitted to do so at any time in the future. Obviously, up until retirement. When you retire, you'll have different tax tables applied. Your retirement tax table will be used. If it's before retirement and you withdraw from your preservation fund, withdrawal tax table will be used. Will still apply to vested provident funds pre 1 March 2021, which is contributions plus growth. This is from the Treasurer. Fund members over 55 from 1 March are excluded but may opt in. If you are retrenched, or pension and provident funds, you'll still be able to access all the savings in your vested component, as well as the accumulated savings in the savings component. Because the current legislation states that if you are retrenched, you can access your money. Obviously, there will be tax implications and there'll be the withdrawal tax table. Again, if you've got a financial planner and they're putting provisions in place for if that were to happen, you should not be accessing your retirement. I kind of stress that any further, because once you have access for retirement funds, you cannot magically get a new fund balance with all the compound interest and contributions you've made and catch up. It's mathematically impossible. Yeah, so that's just a note from my side. For retirement annuities, you'll only be able to access the savings components, which is over here. Because remember, retirement annuities after the 1st of September, it's 1/3, 2/3. Retirement annuities, in general, you cannot access them in the current legislation. So you cannot access that till 55. And then obviously from the 1st of September for retirement annuities, 1/3, 2/3. If you resign from your employer and belong to a pension or provident fund, for pension funds and provident funds, you're able to take the full savings in your vested component as well as the accumulated savings in your savings component. At resignation, any funds withdraw taxed on the vested capital will be taxed at the withdrawal tax table, and capital taken from the savings component to be taxed at your marginal tax rate. I have covered that, but it's just in a summary. So let's do an example from the 1st of September. We've already shown what the amount is from your fund balance. So let's say you made 200,000 Rand contributions towards your retirement funds. 800,000 Rand is your gross taxable income. That's important because 800,000 Rand is generally taxed over here. And if you make a withdrawal, it's going to add to your gross income. You get there now. So the contribution of 200,000 Rand, 1/3 goes to 66,660. 2/3 is 133,340. Add those two together and you get 200,000. New fund balance. This is the 66,660 plus the 30,000 that's taken from the seed capital, which is shown over here. And any amount you put in here, by the way, it's going to actually do the calculation for me. There's a few formulas in here. So it's 66,660 plus 30,000 gets to 96,660 plus the time components. So it's 230. If you made a withdrawal during that year, remember it's over 2,000 Rand, you will limit it to one. Let's say you took out 40,000. Then you're going to pay tax at 39%. Why? Because you're taking 40,000 plus 800,000. You go to the tax table over here, 840. 840 fits in between over here. So it's 39%. So 39% is then calculated on your taxable income of 840. You're going to pay tax of 244,277. Now, obviously, just bear in mind, if I took 40,000 off, I'll just show you here. It's 228 versus 244. Okay, yeah, I guess that's actually, let's do it again, sorry. So that's 228,677. 244. It's actually quite a lot, actually, to be honest. Because you remember what you're taking out, you still have to deduct the tax off when you do your tax submissions. So you're not really getting 40,000 out. You've got to apply the tax. Now, I'm going to get to that innate calculator because that actually factors that in. That's really cool. The guy behind the calculator is a brilliant guy. Love him a lot. Does all these awesome calculators for the industry, which is great. It benefits everyone. So I will put a link to that for you to play around with that one. This calculator is really just to understand the basic components of the two-pot. And if you want to get a bit more technical, then I'm going to give the link to that one. So the tax payable on 40,000 withdrawn is 244,277. And okay, to be honest, if you took the 240 off and you did the calculation for the tax, I'm going to just do it for you. Sorry, I should have maybe have made this an extra line entry. I'm just going to take 228,677 and I'm going to take 40,000 over here and I'll work out the tax 244,277. Sure, you're paying 15,600 Rand extra in tax. So if you took 15,600, you minus still 40,000. Sorry, 40,000 minus 15. You actually only get a net of 24,400 from that. So yes, you are getting 40,000 out from the fund, but when you do your tax return, you're adding 40,000 to income. So you technically could owe SARS money, depending obviously on your rebates, etc. Not to get too technical, but the point is, in theory, you're taking 40,000 minus the tax you need to pay now, but it's not taking. You're not paying tax on 40,000. You're paying tax on your total taxable income. That's why I say, was due diligence done by the Treasury when you did all these things? Because the way I see it, SARS is benefiting from you withdrawing because they're getting more taxable income, especially when you start looking at larger numbers. That's why I'm sort of questioning the whole system, because this is small numbers. Start putting in very large numbers and withdrawing big numbers on high tax rates, and you'll start to see just how much tax one is, how much SARS is making from all of this, which is crazy. This excludes any exemptions, tax rebates, or medical scheme credits, but the purpose of this calculation illustrate the impact withdrawal has in your financial year. Look, I do understand there's tax rebates on the 200,000. I do have a separate calculator which actually works out what that is, but the purpose of this is to illustrate to you the impact that taking withdrawals out, adding it to your gross income. And I mean, let's just go and say you took out 90,000, just to make my point. Pushes up to 264. If we took 264 minus the 228, we'll start to see, I mean, just go quickly, 264 minus 228, 36,000 a tax of 90. Only getting not 60 net. You would have to be very strategic about your tax returns, etc. But again, as I said, Centric is not interested in this. We're not even wasting our time with withdrawals. Rather utilize the rebates. You do have your tax-free savings. I wouldn't access that either because all your interest on that is exempt as well. And you're only limited to a 500,000 contribution. So I wouldn't touch that money. I would have other savings in place so that should anything happen to you and you need 40,000 Rand or need 90,000 Rand, you can access it. I wouldn't touch your retirement funds at all. That's just my opinion. So let's take out 40,000. This is the balance now after withdrawals. The vested components is 370. Just note, I have made a comment here. You have not factored in growth. If there was 10% growth, obviously 10% growth will apply to the 370. The retirement pot hasn't had growth. I'm just doing this very simply to show you the implications of your fund balances before and after taking withdrawals. Your savings pot's now reduced because you're taking 96,660 minus 40,000, and your total is 560. So if you were to now honestly take that, it's 600,000. So again, 600,000 Rand. If you were to go make a withdrawal of 40,000 Rand, that's 560 is a retirement, really, that's your retirement nest egg. And you've now lost 40,000 Rand. You still have to give a tax on that. And if you do that regularly going forward, then how much are you actually eating into your retirement savings? And again, going back to the calculator, which I mentioned, Innate does touch on that. I'm going to pause and go to that quickly and just show you. And this is just for you to play around. I made this template some time ago, but this is just for you to just understand implications of making withdrawals, understanding the different taxes applied to the vested component, savings, retirement, etc. But this is really just for you to understand as an overview how the two-part system works. Right, so let me quickly open up that calculator from Innate. I do think it's quite important to show you. I'm just going to quickly pause this and then go to their website and get it. Right, so I've just pulled up the calculator. Innate is the DFM for Liberty or Stanlib. I think it's for everyone, to be honest with you. Very, very good company. This is their calculator, which they've created. I got this from their chief investment officer, Joao Frasco. He's a really smart guy. He's an actuary and also a chartered financial analyst. He's got a string of qualifications. He shared this, which only got 27 responses. I replied with brilliant. Obviously, I do think it's brilliant. And I think this is a really useful calculator for people wanting to, learn more about the two-part system with various scenarios. So I'm just going to just put it. A really nice slider here. So just make it 35 and 10 to 65. Assume investments returns 5%. Let's just leave it here. Current accumulated savings. Let's just work on 400,000 or 370. Let's see if I can put mine in. Contributions per month. We said it was 200,000. 200,000 a year. 12 by 12. Okay. Okay. Withdrawal amount we said was 40. Assume tax rate. Now mine does calculate the tax, but you said it was 39%. So I'm just going to put it on 39% because I said the taxable income was 800,000. Okay. So years to retirement is 30 because I'm 35 plus 30 is 60. Net withdrawal after tax is 24,440. Okay, so you're taking out 40,000 Rand. It does all the calculations for you. So your net after tax withdrawal. So you're taking 40 out, 24,440 is the net. So obviously, if you take 40,000 minus 24,400, yeah, it's the same as mine. It's 15,600. That's the tax you're paying. So this calculator does that, and that's actually what I should have shown. So full credits to Innate for thinking about that. Your total savings at retirement, if you had not withdrawn, is 62,957,360. Total savings after withdrawal. Okay, so obviously just bear in mind, I have taken out a small amount over here. If I go and throw in a big number here now and say it was 5 million, 1, 2, 3, 4, 5, 6. Obviously, let's go work. Okay, I don't know why I assume tax rate would be 50. Contributions. So the contributions was, say, 350,000. We maxed out the amount. Withdrawal amount you've taken out, let's say it's 1.2 million. Then you can see here, reduction in savings is 1.26. Okay, so 1,270,339, 1,247,926. There's the net after tax effect. And then of course here's a nice illustration graphic. Here are some disclaimers. As you see, it's part of Liberty because Innate is the distribution fund manager for them. But this just gives you a nice graph to show you accumulated savings before withdrawal, accumulated savings after withdrawal, and the impact that it's going to make. So, how long your retirement delay due to withdrawal? 5 months. Okay, so obviously play around with this calculator. As I said, I'm going to leave a link for you to play around yourself. But the reason why I want to share this is because I'm going to assume a lot more other companies are going to make interactive calculators. I was one of the very first to actually make a calculation where it does the implications and calculates the tax. And Innate was kind enough to make this one. Use it, play around with it, understand it. This is for education purposes. I think this is pretty cool. Use mine as well. And hopefully by the time you get to the 1st of September, you'll be a two-pot system fundi. So that if any client asks you or any question in an exam comes up, you'll know exactly how to address that so that you become a better financial planner. Because if this does come in force from the 1st of September, you need to know how this all works. And I just said, when it comes to retirement planning, you really should not be accessing your funds, but it is still important to note, especially if a client is contemplating doing so, you need to do the calculations to show them why it may not be in their best interest. Thank you so much for taking the time to watch this video. Hope it was valuable. It's probably a lot longer than I anticipated this video being, but it is a very important topic that one needs to know. And there's just a lot going on that you need to understand as a financial planner. It is part of your arsenal of skills to understand tax, understand retirement reform, understand different legislation. And that's why we add immense value to clients as financial planners. Thanks for taking the time again. Hope to make a video shortly.